So we will be having the virtual talk by Mr. Robin Shaw on production and trade dynamics. He is the head of the sugar analysis at Marex Spectron. So can we please have the video on the screen?
Hello, and thanks very much for inviting me to make this very brief presentation. As it's only got a very little time to run, I will only cover one aspect, which is the curious interaction this year of the non-index funds and the sugar market. The normal way that funds react to a commodity market is that the human agents, the producers, the consumers, the trade, they analyze fundamentals, they take their positions, and their action on the futures market sends signals to the algorithms of the funds, the systemic funds, and they then follow. They detect a trend, follow that trend, and if they're lucky, they follow that trend until it stops and makes money. What's happened this last year is the exact opposite. Instead of the funds following the human agents, it's been the other way around. And I think it's worth bearing in mind that the systemic funds, they don't have eyes, they don't have a brain, they can't read or think. They're merely algorithms, and most of them are in some shape or form trend following or momentum funds. So what happened starting at the very end of 2023, the funds had done their job, they'd picked up a signal, the signal was bullish, they'd rode on that train for a very long time and for a very high price, up around 28 cents. And eventually,
that's fine, isn't it?
Like all good things, the trend came to an end, the market collapsed, and we found ourselves at the beginning of 2024 down around 28 cents. The funds, which had been long at the top of 190,000 lots, were now flat to short. Or small long. And that's where we stayed for most of the year until September, in a situation where I think the human consensus was fundamentally rather bullish, that the price down at sort of 18, 20 cents was too cheap, as shown by the fact that supply was tight, the market was in an inverse, and there was severe weather risk, and stocks were very low. And then the bullish consensus seemed to be justified. At the end of September, the market shot up 5 cents, and that was on the basis of, or triggered off by FARs in Brazil. But the curious thing was that the funds didn't join in the party. They didn't get on the train. And eventually that rally petered out, as all rallies had done all year. And the market drifted down in a very orderly fashion. And we got back down to sort of 20 cents, and it seemed like the market was getting cheap enough to consider going long, on the basis that, supply was tight. There was a first half deficit to be overcome, and the funds were now flat to short. And so it looked as if fundamentally the market had done enough. But what happened was the exact opposite. The funds came out and sold massively in January, and caught the market, frankly, by surprise, and carried the flat price right down to where we were a few days ago, which is right in the middle of the ethanol parity zone, where the ethanol parity begins to do its job of rationing supply, cutting down on supply in Brazil. And that's where we stand today. So what really happened was that the funds, instead of following, they led the way. They dominated. They anticipated. And one asks oneself the question in a slightly superstitious kind of way, did the funds somehow know something that we missed? Did they read signals that were telling them that the market was bearish? In a way, of course, they did. But what I repeat, they don't have brains. They didn't analyze anything. They picked up on the fact that the human agents, the trade, the producers, the consumers were not standing up against their short, the fund short, and therefore that we and therefore, in a sense, they got it right, and we didn't. We humans didn't. And so I asked myself the question: what can we learn from last year? And I think two things are fairly obvious. The first is that the funds have become much more aggressive, much more predatory. There may be human agents with a lot of money and courage at their disposal who look for trigger points and push by selling or buying, in this case selling, to trigger off moves on the market. This may have been happening in coffee and cocoa. Certainly coffee and cocoa show how the funds have taken control of what used to be human markets. And the second conclusion, I think, is that our fundamental analysis has proved wrong. We were slow to see the writing on the wall. And I think the message has to be that we should pay more attention to market action rather than to theoretical fundamental moves. Anyway, that's all we have time for. Many thanks and goodbye.